What's going on, everybody? You're watching the Stock Market Brief Show. Today's episode, it's going to be important. Why? Because what's going on in the market right now, it's not normal by any means. We've got the proof to show you on today's Stock Market Brief Show. We're going to go over key levels in the S&P 500 to be aware of going into tomorrow's trading session. We'll talk about some of the narratives and catalysts and so much more. If you haven't done so already, make sure to like and subscribe to the channel if you like this type of content where we navigate these financial markets through the lens technical and intermarket analysis. Let's get into it. All right, people. Welcome back. I'm not going to spend much time here on all the narratives and news, but we recently had the SOM rule triggered. If you don't know what that is, you can just do a quick Google. But this typically is an early indication that a recession is here. We have the Bank of Japan. It's under fire for rate hiking. And that is what's potentially causing this yen carry trade to unwind. Then there's also geopolitical risks. Israel's on alert for retaliation. U.S. officials said that an attack may be imminent. On top of all of that, we have Jerome Powell that is going through this blackout period, which we won't hear for till September. I believe also we have the Jackson Hole meeting. There's a lot of concerns around a potential early rate cut, which potentially just intensify some of this stuff that we're currently seeing. Now, with all of those narratives out of the way, what is markets doing? And this right here is absolutely mind-boggling. These are the largest daily expected moves that I've seen for a long time. When the SPY, the Qs, the IWM, IWM's a roughly $4.97 expected move. Just for tomorrow, right? SPY, $10. These are typically weekly. These are bigger than weekly expected moves in most cases. So volatility is here. Yes, and it's not your normal type of volatility right now. We're talking, if we look at back month versus front month volatility, this is way below 1. If you go front month versus back month, then you'll be flipped around. It'll look like it's going up. But back month versus front month volatility is falling significantly to a level that we haven't seen since the pandemic, right? Where it came down significantly lower. VIX took off like a rocket ship today, so much so that we've went back and filled the hidden gap from 4 years ago in 2020. We've talked about this gap a long time ago. If you've been watching this show, you knew about this gap. Well, we finally today shot up to around 66 on the VIX, which is an incredibly large move, right? And we closed just right there at about 38. We talked about how volatility was contracting very, very tightly, so much so that if you look back to the left of the screen, the Bollinger Bands on the weekly time frame weren't this tight since 2007. And we looked at the analog, how you typically got a spike, then it came down, and then a spike up into the 30s. And what's crazy here is we saw that it spiked, it came down, and then we saw a spike into the 30s. Actually, this one went into, the 30s. Pretty wild. And then you saw it come down. You saw it go up and come down and go up. And it was in this pretty high volatility regime after that point. Not to say that the same thing's going to happen, but let's be more specific on what can happen. With the VIX at 38, we can look at what the expected moves are from a yearly, monthly, weekly, daily basis by a pretty simple calculation. But I've got that math done for you over here. You can see that the daily expected move from based off of the VIX, okay, the VIX, which is the volatility index for the S&P 500, it is plus or minus 2.39%. We're going to just say 2.4%. It's technically a little bit higher given the context of the VIX closed a little bit higher than 38. So what does that look like? Well, I've been seeing a lot of people call for a potential bounce in the markets, okay? And I'm thinking to myself, I'm like, it's not really a great call, in my opinion, for you to just say, hey, the market's due for a rip-your-face-off rally, right? So I want to get very key specific, because what if you're wrong about the face rip and rally? What if it doesn't come tomorrow or the next day? What does that actually mean? And calling for a bounce after your largest 3-day rate of change to the downside since the 2022 bear market, right? It's not really, in my opinion, all that amazing of a call. We need to understand what the market is actually looking to potentially do, and then look into the probabilities of where it will potentially close. And I did that for you, right? The expected moves are one thing where you have the upper level, lower level, and your two signal levels. And I've included those on this specific chart where they're kind of just the green boxes. That's the move based off the implied move in the options chain. But then I also extended it out to show the VIX implied move too. And you can see here, we're looking roughly at about, I don't have the exact levels in front of me right now, but just over 528. And then that, and as low as potentially around 504. So this range, there's about a 68% probability that we close within this tomorrow. So yeah, that's a pretty large move. We're talking 2.4% to the upside if we get a face ripper. That would be a 68% chance that we come into this range if we get a bounce. If the bounce is stronger than this, we can look at the 2 standard deviation levels, right? And that would bring us up to and around that 540, right? 540 to 544-ish type of range in here based on those implied moves. And that would be, in my opinion, I wouldn't really necessarily consider this a face ripping rally. I would consider that within 1 standard deviation. But if we actually see a move like this, then let's go ahead and call it a face ripping rally, right? Or if it comes down to these levels, it'd be more continuation of a bloodbath. Now, if we take a look here, this was just the 3-day rate of change, just to highlight that we haven't seen this since the bear market of 2022. And makes sense, right? We've seen some significant sell-offs based off of a bunch of different narratives, catalysts going on, and so forth, right? If we take a look here, I want to explain a little bit more in detail why it's very common to see face-ripping rallies in the midst of volatility. So if I just apply a 1-day rate of change, which today the S&P 500 was down 3%, right? We haven't seen a move like that for a very long time. There's been a couple of years, the 2022 bear market. And what you'll notice here is if you look at this kind of like a, I don't even know what you want to call this thing, but I do it on a daily rate of change because you can see that in the times of low volatility, you get this market to kind of just move up nicely and softly. But in the times of higher volatility where you have these market moving events, through here, through right here, what do you notice the rate of change doing? You see it actually going outwards, right? So you see the days that are higher are also surrounded by the days that are lower. Vice versa in pandemic, right? You see swings of 10% to the upside, 10% to the downside, and they're very close to each other. So my point here is, yeah, you get some big moves to the downside, you can expect big moves to the upside. That is what volatility is. And knowing that, you can adjust the probabilities of where you can potentially find targets and potential entries too if they start to come down and you're trying to be more strategic about what the market perceives as risk. Now, as the VIX shot off today, I wanted to look back through history. We'll date back to the late 90s of the times that we've actually got a VIX close above 40, which has marked somewhat the bottoms of markets where you get these massive, massive volatility spikes. I thought this was interesting that the bear market of 2022, the VIX didn't even have a close higher than where we currently are right now. And that was a minus 25%. We're down, how much do we go down? 10, 12% or something like that in the S&P 500 on a quick spike. But if you look back here, this was the pandemic. You had the China stock market turbulence, the Operation Twix, QE2, the financial crisis. You had 9/11, the dot-com bubble right around in this area here where you saw these spikes. And then you also had down here, you had the long-term capital management blow up. Okay, so we're in and around the range where it doesn't really stay elevated past this 40 level for too long. And in the cases that it does, right, the Fed has stepped in significantly and quite quickly, right? Operation Twist, QE2, the financial crisis, the pandemic, and so forth. So is the VIX, if it gets above 40, how long will the Fed really actually want volatility to remain that high? What are markets going to do in order to keep volatility and make it, calm down a little bit? You got to understand, and I'm going to keep building this into everyone's head. If you're used to trading a portfolio down here at what I'm just using the round number of 100K, right? If it's, I'm just going to say 10. I know it's not at 10, but just say it's at 10 or whatever. Let's just say 20. So say if you're used to trading a $100,000 portfolio at 20, and all of a sudden you're trading up here at 40, that's double the volatility, right? So your daily swings that you're used to of having $100,000 invested in the market are now moving around as on a daily basis as if you had 200K portfolio. But you don't. You still have your 100K portfolio, right? So you're seeing massive, massive swings in times of higher volatility. And this will allow you, and if you understand this, you can reduce your position sizing right? You can reduce your position size if you're entering into new positions, and you can structure the trades a little bit differently when volatility comes in and things start to contract, and you get a little bit of a relief and reprieve from just huge moves up, huge move down, huge move up, huge move down. Now, what I also find very interesting here, I'm looking at the VIX here at 38, but look at the volatility of volatility. The volatility of volatility, which is the VIX, the CBO VIX of the VIX, you date back to 2007 since, it's been around. It's as much data as I have, at least, on it. This thing's up here at 170. And, that's a big difference, right? This is now coming into the times where, pandemic was this high back here in 2018. That was, we saw a spike up there, 2015. But these are some very, very, very volatile times, which goes back to my point. This ain't really all too normal. And we've had many things leading up to believe what could potentially, there's weird divergences, right? So it was so weird. We talked about this one right here. This is the S&P 500, right? Okay, S&P 500. But down here, I correlated it to a 10-period weekly. I correlated to 10-week correlation of the S&P 500 and the housing index. And you see, there's always a pretty strong positive correlation, but every once in a while, you get these spikes to the downside where you have a negative correlation or something breaking. What I noticed was very shortly thereafter, you run into some volatile type events. And well, what do you know? We called it out, and now we're seeing some volatility kind of take place here right now. But obviously, this is just narratives. This is looking at intermarket things, how things are kind of keyed in. But there's also obviously many other things. For example, we're talking about the Nikkei. I mean, this is a crash, right? This is a huge move in a very short period of time in the Nikkei. That right there is crash worthy. I would call that 100% a crash. This is a 13% down day. This last 3 days are probably a historic move down in the Nikkei, right? And then if you look at the Japanese yen futures, this is a massive, massive move coming off the back of what happened with the rate with the Bank of Japan. And as this is taking place, you can look at relative strength lines with safety trades, right? So for example, these are the relative strength line of gold in the S&P 500, utilities in the S&P 500, consumer staples in the S&P 500, TLT, and healthcare. And what do you notice? It doesn't mean that these have to go, that the products themselves have to go up, but relative to the S&P 500, you're seeing the rotation into obviously safety things. Is it getting a little overburnt? Maybe it comes in a little bit? Yeah, sure, absolutely. But you can clearly see here, line go up means those assets are outperforming the S&P 500. So that means what? It means that they're going down less than the S&P 500, right? Consumer staples, it was down 2% today. The S&P 500, though, was down 3%. All right? And then technology, obviously, was the bigger one on the downside, 3.35, and financials ended up being down 2.97% on the trading session. But really, it's not even like that far down from where it has been. And if you look at the heat map, you can run, but you can't really hide in this environment, right? This is a full-blown correlation of the S&P 500 to the downside. And this is what you typically look for capitulations. One day, I don't know if that'll mark the capitulation or, if it does, but this is what you start to look for, where everything, like, you really can't go anywhere to hide unless if it's like the bond, like bonds, right? Or something like that, where you see a real big flight to safety. If you look at the weekly time frame, this bar was the last kind of weekly bar that we kind of discussed on how it's a outside reversal. And if we close through it, it can have some follow through to the downside. Well, in hindsight, it's like, wow, you're so smart. No, you don't, a lot of people don't set up shorts like that, but some do. But that is what happened. You had continuation to the downside. We had warning shots is what I'm trying to say. Now we're back down here roughly at about 5,200-ish kind of range in here. You have 5,000 down here at these prior swing lows after a massive move up. And this is a pretty significant gap. And when you get very extended from these weekly 5 EMAs, I promise you, they will re-tag them again, whether that comes down here more and this comes in and then we see our bounce, or if it comes back in while this comes down and it re-tags it. But that is a frequently tagged EMA. And when you get this disconnected, like we were here, you typically get reconnects at some point. Okay, if we continue on and look at the daily time frame, you can see obviously those 3 days down landed you into the quarterly expected move. It's only August. It's the beginning of August, and we're way outside of the monthly expected move right now. But we did come into what the expectations for the quarter were, and I actually put a 2 standard deviation for the monthly expected move down here. It's at 509. That's for the SPY. And that's also in confluence roughly at about the year-to-date anchored volume-weighted average price. So from a year-to-date perspective, we re-tagged this. Now, what does it mean if we get underneath it? If we get underneath the year-to-date anchored volume weighted average price, it tells us based off of the start of the year and the volume that's traded from the start of the year, if price is below it, it means that the average buyer, based off of volume and time, would be technically underwater. And you can see how the psychology of the market could drastically shift if we stay below that year-to-date anchored volume weighted average price. It tells us that everyone, even that caught this run, right, the average person that's been trading it up to the upside now is feeling a lot more pain. This 3-day sell-off really kind of reminded me back to that 2010 analog that we talked about in May 14th, how we saw the market move up. I think, so the last time we looked at there was 9 consecutive days. And the last time that we had this is 2024 right here, right? We had a 9-day winning streak, remember, in May. And I had to look back and I was like, wow, the last time we seen that was in 2010. And we showed what happened there shortly thereafter in 2010, how the market actually continued to press higher. And then we saw, boom, massive volatility. And what I thought was interesting was, well, we saw the 10-day event, the 10-day plus event or whatever. We saw the market go higher and bam, we get these 3 huge, massive moves to the downside. Now, I don't think that, this is different macro environment, different this, different that. But what I do want to point out here is when you get very extreme volatile events, what do you notice here? You see these moves down and you get face rippers up. Did that mean that we're all out of the clear? No, it actually followed back through to the downside, chopped you up even more, came back down, and tried to find itself some sort of a bottom. But that right there is what volatility looks like. And it's incredibly difficult to navigate, especially if you're not willing to adapt a strategy that you were trading or using when it worked in a low volatility environment. Let's talk about the yield curve now. The yield curve, the 10 and 2, we've been waiting and watching to see if this thing uninverts, and it's continuing to move into that territory. And as it's been moving up, the S&P 500 has been getting hit. Today, it fell a little bit deeper into inversion, and if this comes off a little bit, perhaps that offers a little bit of relief. Why? Well, because we've seen, since we've been inverted, if this starts to fall down, we've actually seen the S&P 500 rally during those periods. And we're not too far off of being uninverted. And I think that's important because we're moving into a time where the Fed is now talking about cutting rates potentially in September when we get more data, yada, yada, yada. But if you'll notice here, I don't have the 2-year in front of me, just the 2-year, but the 2-year is, I think it front runs the Fed pretty darn well. And you should just watch the 2-year yield, if anything. And then whatever the Fed says, I think honestly, they follow or they lag at the 2-year yield. Besides the point here. But what you'll notice here is the times where we started to uninvert and started to cut rates, we started to uninvert and we started to cut rates, uninvert, right? When we started to cut rates, we uninverted, cut rates. Right here, we're trying to uninvert and we're talking about cutting rates. What do you notice that happened? Well, we saw the market turbulence over here in the 90s. We saw the dot-com era, right? We saw the 9/11. We saw financial crisis over here in 28. This was the pandemic, right? So we've seen markets hit all-time highs in these conditions multiple times, right? We've seen them hit all-time highs when the yield curve's uninverted, and every single time, everyone says the same thing. They say, it doesn't matter this time, okay? And maybe, perhaps one time, they will be right about that. But as it stands now, we're still inverted. We haven't seen the Fed cut rates. We don't know what's going to take place next. And I think people have to get more comfortable with saying that because that's the reality. Because a lot of people lost money here, despite even if you knew what was going to happen. For the longest time, you could have been wrong, right? You could have talked about how this was so bad all the way up into 2008. And then you lost all that run, and then all of a sudden the crash happens. And you might be trying to buy into these dips, and you're like, oh man, this is way worse. And then you don't buy back in over here, and you can get shredded. So we need to look more specifically at like these gamma levels and from a smaller tactical base to be a little bit more prepared to save hard-earned capital. Now, if we take a look at the probabilities of a Fed rate cut going into the September meeting, right? I don't know if there's going to be an emergency rate cut. I think that would be the stupidest thing in the world to come out and do an emergency rate cut. I think that would add more problems than anything. I think that means that everyone would look at that as, oh, the markets are probably worse off, and now they're acting late. And that could be a bad thing. And then on top of that, you have what's going on over in Japan and the unwind in the Kyrgyz. I feel like it can all get worse and amplified if that kind of stuff happens. I could be wrong. That's just a narrative. But the market now is pricing in about a 50 basis cut, right, in September. And then remember, the Fed is trying to fight inflation. Inflation's been coming off a little bit, right, and so forth. It's still rather high. In my opinion, where I live, man, it's very high just on the normal day stuff that I use. But they look at, obviously the 2% as their target, the core inflation. And if they start cutting rates too early, too fast, and adding liquidity into the system, what is inflation going to take right back off? They're going to be right in the same darn predicament. I don't know. It seems like they're in a rock and a hard place. But the market is pricing in some pretty significant rate cuts. So we'll see here on new data that as it arrives, what the Fed is going to say and what they're going to do. And we need to be open for the possibility of obviously volatility kind of remain elevated until we have more clarity. If we take a look at gamma levels, taking a look at the SPX chart, this is Owanda, it's not CBOE, so it's off slightly as far as numbers. I just like this chart for that continuity. But what I can see here is a little inverse head and shoulder building. That's just a technical perspective. So if we start breaking out, maybe that opens the door for a little bit of a pop. Okay, that would be the bullish case. But if we're looking at random, these gamma levels, I would pay very close attention to obviously that 5,200. I'm going to have to update this tomorrow morning. I'll do that in the Discord, and I'll do that. I'll probably post it on my Twitter too. If you don't follow me there, follow me there. But yeah, some very key levels would be 5,200, 5,150, 5,100. And then you have the big level down there at 5,000, which is not shown on the screen. But most of the gamma is concentrated up and around this area right now. To the upside, you have 5,300, okay, which was the put wall at the time. So I don't know if this is going to obviously adjust come tomorrow's numbers. But the gamma flip line right now is at 5,500. What is the gamma flip line? This tells you really how dealers and the market conditions are going to be. When you're below the gamma flip line, selling into selling, buying into buying, you get your face rippers, but you get massive moves like this. That's what we're seeing. We've been prepared. That's what's going on. If you look at the 15-minute time frame, we're below a 5-day moving average. It's declining. Those are the two things that I look for in market conditions to let off the gas. So you got to be patient. You got to be careful. If you're trying to buy dips tactically, and you want to, try to scalp here and there, you can do so in times of high volatility with less capital to protect yourself. If you're looking at like investment accounts, that's a completely separate way of strategizing. When you see 10% moves down in the S&P 500, 15% moves or whatever, 30% in various products, you can apply a little bit of, capital to those areas for longer term holds. Okay. But you got to treat day trading differently. You got to trade day trading differently than swing trading differently than from investing, and so forth. As it stands in this current moment, the market priced in a weekly expected move for the SPY at $13.32. Day one, we are trading outside of that. And yes, that is the largest expected move I've seen in the SPY for a while. I'd have to go back way far to see when the last time we started seeing those type of moves was. I would imagine it being like 2022. I'd have to go back. And then the SPX originally expected move was 140 or 138. And that is the expected move, but I did refresh it more closer to the, I had more time go by and it ended up being like 170 or even higher. So this implied move, the expected moves, there's a lot of volatility. You got to be careful. You got to be cautious, obviously. We talked about a lot today. More importantly, going into tomorrow's trading session, what can you expect from a probability standpoint? You have a 68% chance we're going to close within this white box, 95% chance that we're going to close within this box. So if we come down to these levels, just be aware of that. We'll use other tools too. I don't think I'm going to be going live, but I'll post them in the Discord as time progresses. Or if you're in the Discord, you can actually just use the query channel yourself and do so. I hope today's episode helped out, gave you some insight into things that maybe you didn't see anywhere else.